Recording now. Now, to be honest, one of the main things I wanted to talk about, because I've been asked questions about this a ton lately, is just like general optimization and even just seeing people and students especially that may be in harder places and in their own personal life and their own self-development journey. I did want to talk about this a lot, but just the general idea of optimizing the work you're getting done, whether it be back testing and trading, but also like the underlying mental aspect of that. Because I'll be honest, it's so cliche, and I get it sounds cliche, but if you are not working on yourself off of the charts every single day when it comes to things like fitness or finance or even just studying and research or pumping yourself full of education and information, I promise you, I don't want to say that it's going to take you longer to find success in trading. It 100% will, though. But I do want to say that in most cases, you may not even find that success you're looking for in trading if you can't work on everything else off the charts. It's just the reality of it, and it's the reality of any space. And I want to talk a little bit about optimizing that. I want to talk a little bit about, the importance of that mental aspect of things. And then I do want to dive a bit into personal finance, because similar to mindset, I think that if you don't have a base, a strong foundation, even when it comes to finance, trading is not going to be the holy grail for you. If you can't understand the importance of investing, long-term investing, compounding, managing your own money, increasing your savings rate, budgeting, if you can't understand these things, no matter what payout comes your way from a prop firm, no matter how much money you make in trading, you are not going to be as successful and as optimized as you can be. And nowadays with social media, this is a even bigger topic, where the sad reality is there is so many young people on social media making an absolute killing out there. And, whether they have a small business or they sell a product through their social media following, whatever it is. But the issue is they take that capital, they massively increase their lifestyle. It's called lifestyle inflation. They're going to buy the nice cars, maybe moving uh, to a home, or collecting a new rent payment because they want to go and move into a really nice place or move to LA, whatever it may be. Just in general, wasting the money that they're making from an income stream. I can 100% promise and guarantee you, as you guys, because there's some of the people in this call right now who may have started making money from trading. If you are taking that money and not using it correctly versus using it correctly, it will 100 times compound in the longer term for the decisions that you make. And I feel like, I'm kind of proof of that. With my first payouts, with all of my income that I've made and now delegated it into many other income streams, I have 100x'd my net worth by being smart about it. I still drive a basic car with great gas mileage. I, still moved back home after working on university online right now, moved back home, and just saving and saving and investing my money. I'm telling you, my net worth has absolutely exploded from doing this. There's no need for me at 24 years old to go buy Lamborghinis and go move to LA and whatever the hell other people are doing nowadays on social media. And I do think a big part of that kind of circles back to the poll that I mentioned the other day. If we want to go here. So this one here, it was, there's kind of reasons I ask questions like I do in these polls, but what is the average age someone reaches a self-made millionaire status? I think in general, the answer, that most people chose was 38 years old. I don't want to call anybody brainwashed, but you guys got to keep in mind how much that idea is skewed from social media. The vast majority of self-made millionaires reach that point at 57 years old. That's the correct answer to this poll here. And it's backed by 8 different studies that I looked at, all ranging actually technically within this range here. So about 57 to 61 was the range that the majority of self-made millionaires on average reach that status of being a millionaire. And, it goes to show, the more social media consumption, the more that you're seeing these people online who are making ridiculous or hyper financial decisions at such young ages, you got to keep in mind, not only is a lot of this probably debt, at the end of the day if they're driving sports cars, Lamborghinis, whatever it is, as content creators because they make more money from those flashy lifestyles. But you got to keep in mind it slowly drags this number down and down where people start to believe that 24 years old, 31 years old is where people are reaching millionaire status, which is such an unfathomable number that some people can't even comprehend or understand the weight of anymore. So I did want to talk about that a bit. And then this one was even crazier to me. I will admit this one seems a bit long, but the actual answer here was 28 years, which is from the start of your finance and business journey, how long on average to achieve millionaire status. A lot of people put 16 years. I think I would agree with this actually. It's probably a bit closer to this range that we're seeing here nowadays due to the internet and social media and whatnot. But 28 years was the correct answer here. Also, in 4 different studies that I looked at, it ranged once again from about the 26 to 28-year range. And I do want to talk about number one, the understanding that most of this in most self-made millionaires reach that point through simple long-term investing, even through a job and a 401k. So not everybody that's a millionaire is someone who's on social media, running a business, selling a product, whatever it is that, we see nowadays. The reality is the vast majority, the huge majority of people who do reach millionaire and self-made millionaire status reach it at 57 years old because they might have had a W-2 9 to 5 job that they hopped into when they were young. They might have started their investment accounts and their long-term investments and then just let it grow and compound. And eventually, at that 57 years of age, is when they will reach that millionaire status by just doing simple long-term investing. Now, I mention that because you guys know I preach investing so much here. Like, I think it is the most important thing to do because, number one, if it's creating the most millionaires, clearly there's some method to the madness behind it. But the other thing is so many people have this idea that, well, JB, I don't want to be a millionaire by 57. I want to be a millionaire by 24. If you are not doing those fundamental aspects of personal finance, like investing, delegating into different asset classes, whether it be gold, crypto, the stock market, real estate, bonds, whatever it is, more commodities, if you're not doing the fundamentals that are getting people to millionaire status at 57 years old, you will never in a million years reach millionaire status at 24 or 31 years old. It's the truth behind it. I get that people don't want to take their money, throw it in an investing account, and let it sit and compound. But if you don't have that financial responsibility or that even discipline with your finances at a young age, you will not even reach it at 57 years old because you're going to be too busy chasing these buzzwords and new marketing strategies and new business models at this age, blowing tons of money, wasting it in different places that you'll never end up reaching that old age with a millionaire status in general. So it's something I kind of wanted to talk about. You guys know, well, most of you know if you're new here, I don't want this to come off in the wrong way or like a braggadocious manner. But you guys know I have obviously been trading for about 6 years now, with my live capital for about 2 with prop firms previously. And even FTMO has moved back to the States. So that's something I'm probably interested in the near future. Maybe trying to scale back into some prop firms for just some additional income there. I also have I heavily push long-term investing. You guys know this as well. Of course, I push the idea of set and forget ETF or index fund based investing, long-term outlook, and just letting it compound. On top of that, you guys know I have my real estate business where I put a significant amount of work per week. And it's one of my largest active income sources. I do a lot of outbound marketing. I do a lot of direct mail, cold calling, things of that nature to get in touch with people. And on top of that, I do a lot of investing in the real estate side of things, whether it be syndications, which is kind of a group of income coming together to buy certain properties. I have other asset classes related to real estate. And on top of that, I head back on Wednesday actually to finish up my master's degree in data analytics. So that'll be, my last year. I'll get my master's degree in data analytics. It's kind of in our niche as well. It's in the finance and business focus. So I actually do a lot of portfolio management in school. I do a lot of data analytics related to stock markets and pricing of asset classes, things of that nature. And I feel like I'm even forgetting more, but my point is I have my hands in a ton of, well, I guess Simple Markets as well. Is another business. I'm learning a lot of skills through Simple Markets related to email marketing, marketing as a whole, content creation, understanding social media and algorithms. Like I say this because I want you guys to understand I have my hands in so many different baskets that I want people to realize that there is levels that you can push yourself beyond when it comes to efficiency, optimizing your lifestyle. So many people feel like, hey, you know what? I'm already, I've maxed out what I can do. I'm working as hard as I can. I promise you, if you fundamentally expand your discipline into different things, that comes down to things like journaling, especially fitness in the gym. You guys know I'm in the gym every single day. I think it's so important from a discipline aspect, even expanding into the gym, eating a healthier diet, waking up and going to bed at the same time every day, even optimizing your hormones like testosterone to try and push yourself to a point of being able to be more motivated, get more work done, increase your focus by limiting social media and content consumption time. I'm trying to really, really push that idea more on a lot of people. I get DMs from people on a little bit more of a personal level outside of the community. They talk to me about their life, how things are going with the gym or with school. And, I think it's so fundamentally important, especially at a young age. I just turned 24 a couple weeks ago. Um, Actually, I guess a little more than a couple weeks ago now, but I just turned 24 at the end of July. And it's so important for people my age to really continue like that self-improvement and pushing yourself. And that's why I wanted to talk a little bit about the education section today. Because you guys know we have a bunch of content in here, but some people kind of, let it sit on the back burner. They don't use it much. And I wanted to talk about, number one, we have workout programs in here that you guys can literally download and copy if you were looking to get into the gym. We have nutrition guides, which is another big one. I think that health and fitness is absolutely key. If you want to be a trader, I am sorry, but if you are the type of person who rolls out of bed at a random time, doesn't have the discipline to backtest, eats junk meals, doesn't take care of their health and their mindset, you're not going to have the ability to focus and truly have the mental capacity to become a trader. And I'm telling you, these other aspects of life, although people throw them on the back burner, they say, well, who gives a shit? I want to make money. Why should I be in the gym? Or who gives a shit? If I want to make money in trading, I don't need to eat good. It doesn't matter. I promise you, this stuff matters so much more than you might realize. And like I said, I have 20 different things going on. I would not be able to do absolutely any of that if I didn't have a fundamental baseline of discipline from the gym, from eating right, from journaling every single day, writing down certain tasks and being organized. And even, this whole section here talks about podcasts. Every single day in the car now, I don't even listen to music anymore. It's been like probably 3 years since I only started listening to podcasts in the car and during some, slower work periods or late night work periods. All of these different podcasts are listed for you. We have a link to them. Give it a shot. You're going to increase your education so much by doing something as simple as this. For trading podcasts, Desire to Trade, he talks to a lot of professional and full-time traders. He just interviews them, asks them different questions about trading and whatnot. Now, the important part of podcasts is you are going to learn so much from replacing the same old playlist. You guys probably listen to rap or whatever you guys listen to. Replacing that playlist with a podcast, the exponential amount of learning that's going to increase there for trading or any sector you want, finance, is huge, to the point where you have to get into the ability to narrow down the information being said here, take it with a grain of salt, take it at a baseline. Don't dive too deep into trading podcasts. You are going to hear about 700 different trading strategies in this podcast because it's all different full-time traders. Understanding that you are on your own path, take the info you need. But Desire to Trade is a great one. The Trading Psychology podcast, this is a huge one. I've never seen a podcast with as many episodes on the topic of trading psychology. And I promise you, listen to 2 of these episodes at random, choose 2, and you're going to be like, you know what? I didn't think my trading psychology was that bad, but these topics are exactly the issues that I'm facing in my trading right now, and they talk about them in every single episode. And then Chat with Traders is another one. I don't listen to this one as much. I've kind of touched upon it briefly, which is why I listed it here. When it comes to finance, this is by far the number one in my opinion. the Rich Habits podcast. Bigger Pockets has a money podcast, which is also great as well. Um, and business, I'll be completely honest, the game with Alex Hormozy, I listened to for a long time. I don't really enjoy this one as much as I used to. That's just my opinion, but I think there's so much information there for newer people who are trying to get into business. And then real estate, Bigger Pockets is obviously number one on there. And then self improvement, Huberman Lab. I'm listing these because I want you guys to understand, if there's any of these topics that you want to learn more about, the more you surround yourself and envelop yourself with the topic, the more you're going to learn, the better you're going to become at it. And I'm just trying to get you guys in the habit of, like I said, I have 20 different things going on at once. I optimize every single part of my day as much as possible to fall in line with these different topics and aspects of my life that I'm focused on. Real estate, I listen to real estate podcasts every single time I get in the car. When I make my real estate phone calls on my other monitor, I'm working on simple markets and different marketing for this business. It's one of those things where just hyper optimizing yourself and your life for your goals needs to be so much more appreciated. As of right now, there's a lot of people who, when I hear the lack of confidence they have in themselves or even their ability as a trader, it stems 99% of the time from their lack of confidence in their everyday life. Even if it's a 9 to 5 job that they don't like, they hate waking up for it. They're in the mundane routine. They don't work out. They don't focus on finances. They don't learn and educate themselves through something like a podcast or a book. They're going day to day, just basically, I don't even know what to call it, but just going through the motions of life and not focused on that overall goal as if it is their saving grace. It's the last thing that they need to do. And I just really, really want to push this section more so people understand that, because if you don't surround yourself with everything related to the topic and the goal that you have at hand, you are not going to be successful compared to the person who is all in on trading. They're back testing. They have the discipline to work on their health, their mindset, their confidence. It's going to carry over to the charts. They have the ability to work on their finances, so they have a great, strong baseline. So when they do start making prop firm payouts, they're putting it in the right place and hyper optimizing it. It's just so, so important. And I did want to dive a little bit into this PDF that we have. Now, I wrote this a couple of years ago now. Let me pull it over here. So I wrote this. It's like 53 pages. And we have a table of contents here. You guys have access to this too, by the way. I get so many people who I refer to this document when it comes to like this, especially this section down here. Preparing a portfolio, an LLC, business law, stocks, indexes, asset diversification. Like, I refer to this a lot, and some people don't even know where to find it. It's right in the educational personal finance section. But I did want to talk a bit about, not only some of these topics here, but I want to get an understanding, is this something that applies to the majority here? I know that in other countries outside the US, credit does not really work the same. Do you guys use credit on a day-to-day kind of basis? How is it internationally, the way that credit is used? I know that in the US it's very different. So what we specifically do with credit is you're essentially, with money you don't have in a bank account, you can swipe a credit card as easy as ever nowadays, and you'll just be in debt. Let's call it $5,000 if you spend $5,000 in that month on credit, and then you pay back in interest every single month to the bank or your credit lender. And I've talked about this with Andre and Sven before. They mentioned this is not really how it works internationally, but let's just say your credit card rate is 20% and you spent $5,000 in that month. You are going to have to go and pay, what is that, $1,000 in interest on that $5,000 that you spent in that month, and it's going to compound and add every month. How is the yearly interest in states for credit? About that, yeah, 20% APY, for example. I think I said monthly, but yeah, so it is very high in the States. And depending on the credit card that you use, it can be even higher. It's usually better on stuff like mortgages or different types of loans. Credit cards are probably one of the worst types of debt you can get into here. but it makes a big difference because some people really do not know how to manage them. I will probably go over these two sections first. I want to go to base financials. So, calculating your net worth. This is such an important topic related back to that poll that we did the other day regarding millionaires at a certain age. For home loans right now, you're looking at about like 6 to 8% um, for average mortgage in the States right now. I wonder if that's considered high or low to you guys. But yeah, so calculating your net worth is just adding up all of your assets, subtracting the liabilities, and that's what you get as your net worth. And this relates to the question we talked about the other day, where people who are reaching millionaire status reach it at about 57 years of age. Not only are they making a ton of income by that point, but at the end of the day, they're also cutting down their debt or lowering their payments on debt, whether it be a house, different vehicle loans they've accumulated over the lifetime of, or over the course of their lifetime, and student loan debt, all of these things getting paid off, coupled with their income increasing, kind of plays, both ends of the spectrum here, increasing their net worth to that point of being a millionaire. And if you do not have a strict calculation of your current net worth, I really recommend doing it, because not only is it eye-opening, but it kind of lets you keep yourself accountable. We have that net worth tracker in the education section as well. The community, in every quarter you can go back, or every month you can go back and say, okay, how much debt did I pay down? How much money did I make? And it's just super important, because it is like your fundamental baseline of your current success financially, and everything can be added into this. Bank or money market accounts, CDs, cash that you have on hand, stocks, bonds, mutual funds, your 401k with your employer, for a lot of you that might have a 9 to 5 job and a 401k, a house, for example, or land that you own, any vehicles you own. And then, in my opinion, some of these definitely get smaller and smaller, like jewelry, furnishings. I don't really calculate any of that into mine. Privately owned business, whole life insurance, all of these things add up to create your total asset column. And then your liabilities, if you have a mortgage, if you have home equity, vehicle loans and student loans are a huge one, credit card balances, creating that picture of your total net worth, calculating it, and then getting to a point where you can say, okay, here's where I am in August, or well, now September of 2025. And you should have a goal by January 1st of 2026. We listen and don't judge. And having that goal by 2026 in January is, a key to keeping yourself accountable. And if your net worth is not moving in that 3 months of time, you need to kind of make adjustments. You need to fix the way that you're saving and budgeting. Kind of what I want to talk about here. And budgeting and expenses. I use an app, it's called Rocket Money. I'm not sponsored by that shit or anything, but it's called Rocket Money, and I just like it because it tracks everything in and out of certain bank accounts. And I have about 7 bank accounts, so it makes it so much easier to just see it all in one place for me. And I can link all 7 of my bank accounts to that one account, and then it tells me what goes in, what goes out. It categorizes my expenses, and it keeps me accountable in seeing what I have and where it's going, how much is coming in, how much is going out. I put certain money aside. Rocket Money. Yep, Rocket Money. It's like just an app I have on my phone. Literally just like a white logo with a little reddish purplish half circle on it. But yeah, I mean, I use it because it's super simple for me, I feel like, and having so many bank accounts, I can kind of manage it better. But the most important part, and like the key to that, is you guys will find, if you start budgeting or using an app like that, how much money slips out the door every single month for like stuff that was not necessary or needed. So much discretionary spending in our day and age happens, and all of that money being able to cut down on your expenses, increase your savings, it is the biggest, most pivotal, proven by data also, thing to your success and financials. The number one aspect that creates a millionaire in the future. This was a study and actually a poll question I did a little while ago in the group, but it's not investing, it's not your debt, it's not how many assets you own, it is literally your savings rate the amount of income that you make and how much you save percentage wise is directly related to your success or your ability to become hyper financially successful or financially free longer term. It was your savings rate. And it's because nowadays, where we live, or the way we live, and how much marketing there is, and how many new products and things that, you know, marketing getting as good as it is, people go and spend more and more and more than they ever have before while making less or the same. And it's completely destroying your ability long term. So please, at least get a budgeting app. It takes 4 seconds to download one, set up your account, and it's passive, and you can start looking at it month to month or week to week, whatever you want to do. And the importance of this, how and why to save, obviously, understanding compounding. For the younger readers, I talked about it in another poll I did, where if you start investing from 20 years old and then you stop when you're 30, for someone who starts at 30 and ends at 60 years old, that person has invested 3 times the amount. If you invest the same amount in the same place, they've invested for 3 times longer, 30 years compared to 10 years. But the person who starts investing at 20 to 30 will make exponentially more than the person who invested for 30 straight years from 30 to 60. That was another poll I did. Almost everyone in the community got it wrong, which is why I want to touch back upon it. And that does come down to compounding. The sooner and the more that you invest, the more you will make in the long term. And realistically, if you just dialed in, invested as much as you physically could from 20 years old to 30, you can make more than people who wait on it and they say, you know what, I don't have enough money to invest yet. I'm going to push it off till I'm 30. Literally any dollar value will make a significant difference due to compounding. And then a few simple ones. The rule of 72. If you divide 72 by your expected rate of return, it'll give you the number of years using compound interest that you can expect your initial capital to double. So this is a common rule used in investing. Now, the S&P 500, we talk about how it has an average return of 10% per year. So if I take $5,000, I invested in the S&P 500 with an average return of 10%, 72 divided by 10 means 7.2 years is how long I can expect that 5,000 to double. Now, to some people, it's not a lot, but if you extrapolate that out, let's say by 4 different doubles, so that's 28 years, it goes from 5,000 to 10,000 in the first year, or the first 7 years in doubles, 10,000 to 20,000, then 20 to 40,000, and then your last one is 40 to 80,000, turning your 5,000 into 80,000. And the most important part of that is over that course of 28 years, you should be investing more and heavily. You shouldn't just set and forget $5,000 and call it a day. So even if you have $100 to invest today, it is proportionate to your current income. I would not, if someone's making $5,000 a month and they wanted to put away $100 in investments, I would say you need to increase your budgeting and your saving and your expenses, because you're clearly not committed to it as you should be. But for most people, if you're only making a few $100s a month and you invest $100, it is completely proportionate to your income, where in 2 years' time, you will see a significant difference in your net worth compared to the person who's not doing that. That's why I bring this up. I want you guys to be smart with the money that you do make from trading as well. All of my initial prop firm payouts went into an investment portfolio, a personal trading account, and then to start my real estate business, and delegated it accordingly. I started my real estate business with $3,000, which is so small when you look at the grand scheme of how much I've been able to expand my active income and net worth using that small amount of money. I understand $3,000 might not be small to some people, but I'm trying to get you an understanding of the ROI and delegating your capital to different important areas and why that's so important. My investment portfolio has almost gone 3x in total since I began, 300% return, which to my net worth essentially means I would have 1/3 of the money I have today in the markets compared to if I didn't invest at all, which is so massive when you include how much I'm saving, how much I'm putting away, scaling and compounding. And, I don't want to go too deep into the math of it, I guess, and I don't want this to come off the wrong way, but I've even done math where if I didn't invest another dime until I was 65, I'd be sitting on about 14 million by that time. And, like I said, I don't like throwing dollar values out there. I don't want that to come off in the wrong way, but I say this because of how young I am, how much I'm putting away. If you want to get to that point of financial freedom, it takes that, early stages of your life, locking in, saving as much as you can, putting as much as you can away, being smart with your money, and you could have that long-term success. It's just what I hate seeing is a lot of people, especially I've gotten DMs about it recently, people saying, "Oh, I don't have enough to invest yet. I'll wait." And the issue is that waiting turns into 5 years, then 10 more years, 15 years, and then every single person by retirement sits there and says, "You know what? I wish I did invest more when I was younger," because they don't have as much as they assume they would in the long term. Um, this is an example of some compounding. $5,000 a year investment at an average rate of 10% return. In just 10 years, you went from an initial investment of 5,000, scaling it in each year to about almost under $100,000 in just 10 years. Once again, this is proportionate to your income. If you don't have $5,000 a year to invest, if you have 1,000, it's going to have that same compounded effect. And then of course, minus inflation, which you don't need to talk about too much. But I really, really just want to preface that if there's any takeaway in this whole webinar, this beginning section of the webinar, before I go into a data review I wanted to look at, please understand that the smarter you are with your money younger, and when you are making money from things like trading or online businesses or other incomes that you scale, the better you will be in the long term. I have seen so many people that I used to trade with prop firms. They would be making payouts the same way I would, but then they'd go and buy a Rolls Royce, they'd go and move, they'd go and increase their lifestyle. Exactly, diversification. But they'd go and it's called lifestyle inflation. They'd start buying more in nice things. Diversifying that money that you're getting from prop firm payouts, even creating more income streams from it. Like I said, I took mine, I put it into the stock market, which is one huge income stream for me now, as for years and years now I've been putting money away. I put some into my personal trading account, which of course is another stream of income. I had some into dividend stocks, which generate me cash flow month over month. And then I took some of that money and put it into my real estate business, which now is one of my highest active income streams. I took that money, I made the absolute most of it, and now I make, I don't even know if I can say 100 times more. It's probably even more than that. I probably make 500 times more from being smart and, intentional with the money that I made from prop firms when I used to trade for them, compared to what I would be making nowadays if I didn't do any of that. I took my couple $1,000 payout each month and was just sitting there and blowing it on a new car, buying new clothes, letting lifestyle inflation creep its way up. I wish I could even possibly do the math on that, but can you repeat this last statement? Just essentially being intentional with your money, with your prop firm payouts, the money that you're making. So if you're asking specifically about what I did with my personal prop firm payouts, I mentioned I put some into a personal trading account. That was something I did fairly commonly, because I knew at some point I wanted to probably scale away from prop firms, especially with kind of the regulations and how they were moving years ago. And then that kind of allowed me. So number one, my Forex funds went under. They had that whole lawsuit. That was the main firm that I traded with back in the day. And I instantly had a personal trading account that I could say, you know what, I've been putting money away. I can start trading this personal account more, maybe up my risk. And now 2 years later, that's a huge income stream for me. I also put money into my stock portfolio and a dividend portfolio. And both of those generate me a significant amount of money nowadays as I continue to scale and put more income into it. And then I even took, $3,000, put it into, a mix of a weekend jobs capital and prop firm payouts. I put that into my real estate business, and the ROI on that is absolutely significant. Being able to start a business with 3,000 and scale it to, the point of what I do in real estate now. But the point of why I say this is just to be intentional with your money, saving more, being smart with it. You can make so much more out of money online and the money that you're making through prop firms. I don't have an FTMO account. I haven't even bought one yet. I know it's kind of crazy. They just came back to the States, but I really do. Investing into education is a huge one as well. That's a huge, huge aspect of it. Like I said, I'm constantly trying to educate myself when it comes to real estate too, going to meetups and whatnot. But switching back to the FTMO account, I haven't bought one yet, but I definitely am interested. I'm reading more into it to get an understanding of love to see me on the leaderboard. I am not no leaderboard trader. I think I'd plan on getting funded though. Yeah, FTMO leaderboards is, in my opinion, a garbage mess. Some people up there making 100% a month, like, but it's usually through over leveraging and kind of a different strategy approach to prop firms. But yeah, I mean, I wouldn't mind trying to get funded again. I'll admit I'm comfortable with my personal trading account right now to the point where, scaling back into funding, it'd have to be, yeah, that's kind of where I'm at. If it's going to be more of a headache with rules and phases and all that kind of stuff, then maybe not. But I mean, I'm still looking into it. I'm trying to get an understanding of how CFDs are banned in the US, but they're allowed to have US clients with FTMO. I'm still reading into that a little bit because back when my other firm that I used to trade with went down, um, they ended up closing in on CFD trading a lot in the States. And there was so many firms that I would go and trade for them, pass the evaluation, maybe get a payout. And then all of a sudden it would be like, oh, sorry, we're no longer taking US clients. I'd be denied payouts. I'd have to restart phases with a different firm. I did that like 4 times before I finally said, you know what, I'm done with firms. I'll focus on personal capital. I don't want to run into some BS headache like that again. Um, but yeah, I'm still looking into it a little bit. I've been waiting for at least some firm with some longevity to come back to the States. As you guys know, we've been banned from literally every prop firm there is. And the ones that are not banned are ones that are operating technically illegally, so I don't want anything like that either. But I just got a message from someone. But yeah, I mean, it's something I'll look into for sure. But kind of goes back to what you said. It's diversification at the end of the day. If I don't have to increase my time output trading each morning, I hop on at 9 a.m. to set my orders each morning. If I can do the same thing with an FTMO account or an evaluation or whatever, I have no problem doing that. It's increasing my income streams without really stretching my time too thin. So it is something I'll be looking into for sure. Someone just sent something off topic. All right. I did want to look at some data reviews today and I want to make sure I'm not missing questions. Let me pull up. I have 2 here that I'm going to pull up. Let's see here. So this one here is from Jerome. And one thing about this one, I do want to mention to him. Let me check questions. Oh no, data review time. In the past, did you try? No, I haven't tried futures firms. I just feel like for me, I think swing trading is kind of my style at this point, and I know with futures it would be a little bit tougher to do something like that based on their rules. Um, so yeah, I haven't really gotten into futures. Now, one thing I will say, I can't go too in depth here with Jerome's data. Um, if he's watching this, maybe I would really recommend, you know, these metrics here, in my opinion, are what I would consider a bare minimum. You need to understand your win-loss ratio. You need to understand your wins, losses, and gain, your net P&L, your balance, obviously, and your total RR. When I look at this, I just genuinely don't have enough information to draw any conclusions here. I just see 8 total RR, which to me looks good. I don't have a time period here. I don't have anything with pairs. So, I can't really go over this. I would love to. Okay, we have some dates here, which is good. I don't know if they're correct because I don't see any. There was information that was. No, so this one, hold on. Let me pull up your sheet too. No, so that one I did scroll to the left and it was not what you guys are thinking here, but I just want to let them know that this information, hold on. He deleted a review. Okay, so I have his updated one. There we go. This one here, hold on. So it's the one we're looking at, but this one you can scroll to the left. Because yeah, he DM'd me and said, hey, can I delete a data review? I posted the wrong sheet. Should be this one. There we go. So let me, and then I edited this on this one earlier. Sorry, I'm trying to set it up for him here so I can, because yeah, he basically emailed, or not emailed, DM me saying, hey, I submit the wrong data sheet. So I do want to take a look at this one, which should be his updated one. Trading Journal 2. So this one has more info for me. The equity curve's a bit messed up here, so I'm gonna fix that. What are we looking at here? 100K minimum balance. I wonder why it is messed up. All right, I'm gonna go for like 80K because I think that's probably where it drops down to. Okay, this is kind of the overall view of his equity curve. In my opinion, lacking a little bit of consistency here, but you could see he did end in 8 RR profit overall, which I think is great. So first thing I notice here, I think the biggest difference, I've talked about this before, is you got to understand when you're backtesting, you are learning as time goes on. You're going to get better and better with the plan as time goes on. In my opinion, that's kind of what we're seeing here, where he was stagnant for a long while here, probably learning the plan, getting better with setups, understanding it. And then as you can see, the end half of the year here, which is about what is that, a 6-month period or so, 7-month period, he starts seeing a lot more consistency with some relative drawdown and just continuous improvement on the equity curve. So as you get down the bottom here, I'm sure we're going to see a lot more winners and a lot more improvement. So I think that's a great thing. His win-loss ratio is about 52.59, which I think is also awesome. A little bit on the lower side, though, compared to what we like to see when it comes to an overall. And based on the profit here, if I had to assume, his win rate will be around 27%. Yeah, I was right on the dot there, but 27%. And I kind of get that from the idea that he's lacking a little bit of that consistent profitability. But if we go ahead and we take this and we cut it to, let's go with E60. Oops, sorry, wrong column. That's definitely not correct. Oh, that's why. So as you can see, basically what I did there, I just cut out a lot of that learning curve in the initial trades, the first 60 trades or so. You can see that win rate gets dragged up a lot closer to 30, which is a lot more profitable, which is kind of why we see that expansion at the end of the equity curve. Perfectly normal there. So for Jerome, I wouldn't sweat this backtesting session too much regarding the specific data, because I think what you're seeing here is just what you're supposed to be when it comes to that learning curve as time goes on. Of course, on a live market and as time goes on, you're going to see better improvement here in your win rate overall, but I think it looks great. I want to read some of these notes. Missed due to break even. Okay, so he logs kind of like I log in my journal. If you want here, Jerome, you can kind of do something where in this column, you do an equal sum. He'll drag this down. And then you'll enter here. So that's going to give you the sum of this column. And then if you want, you can even take it a step further. Add this to it. So what this does is a missed win due to break even means that you lost out on 3 RR. Saved loss due to break even means you missed out on -1. Missed win is another 3. Missed win, and then -1. Copy that here. So basically what I'm doing here is you're just seeing the RR as price goes on, or as your different wins and losses go on, you're kind of tracking what your RR would be with or without it. Other than that, though, I think this data looks great. There's not much I'm going to say about it. It looks perfectly normal for someone who's getting started out with the plan and kind of learning their, to get more used to it. I think the pairs look great here. You did a good amount of pairs, which is another important thing I typically look for, and a good period of time. So yeah, not much I would say about that. I think it looks great to me. I would just recommend keep going. And the second set of data is where I'm interested in looking at it, because I think your trades look good here. I did look over them on that other sheet I was talking about, that older one. But I think the important part here is on the second set of data, we might start seeing a little bit more of that consistent profitability because you do seem to be improving as time goes on with the edge. And then we have one more data review I want to go over as well. We can 12:47. We got time. So now this one you mentioned, finished 2018. Results came out terrible. Hardest part is knowing which structure to focus on. The first thing I will preface here, because I do know you're in call as well. This amount of testing in this amount of time really could be overdoing things for you. I do think it's better to space it out. You know, it's great that you're motivated to this extent, but just be careful because we even have a little section on it. Let me see if I can find it. In trading psychology, it is, we call it this little cycle here, but the trading stress cycle, but it's a loop of someone who more testing, they want faster progress. Over testing leads to a lot more stress and confusion, which leads to worse data. And then, you know, obviously trying to fix more problems, and then more testing and desperation to fix it. And then increased confusion and burnout, quitting. You know, it's kind of quality over quantity when it comes to testing. This is insane. I'll be honest with you. I don't even know someone who could test the amount. You've done every single pair for a whole year of time, and literally it must have been 2 days since your last data review. So really space it out for it. Don't let yourself get overly confused because the data doing worse in this situation, I bet, has a lot to do with that. And obviously it's, you know, that consistent negative profitability here with the lower win rate. In order to be profitable with this edge, you need about a 26% win rate at minimum. Sven told me I should up the volume from 2017. I agree. You had kind of two very large spectrums here if we look at your other reviews. So your first review, I think, had 600 and something trades. So here, you know what? I could probably pull them up. The one that Andre went over. So this one, we have 2017 here, which I'll pull up right now. It's just taking a second to load. All right, we'll pull that one up. So this one here, oh, it's in the same sheet, I think. Let me see. Is it the same set of data as 2016 here? God, I have so many sheets open. All right, let me close this one off. Okay, so back as 2018. Let's close out this one. All right, so number one, the 2016 set of data, I think your total winners overall, enable editing, were, so yeah, that's like 670 something trades, which is extremely high volume. And that's what I tried, bottom there. Yeah, same sheet, gotcha. And then, I don't know if it's in this one now, it's in the other one though. So 2017, that immediately dropped down to, you know, 250. We'll add some winners in, or the break evens into this and see. So yeah, it dropped way, like almost in half. So I think both situations, you seem to do a lot better with this set of data here though, dropping those repetitions overall. And to me, I don't understand this data. So hold on, is there an equity curve on here somewhere? Okay, here we go. So how can your win rate be this high with a loss that significant? F2, G2, total wins including, so that must mean your realized win rate is extremely low here. Yeah, which means a significant amount of break evens, which is interesting. I have not seen a set of data that has this wide of a gap between your realized and your overall win rate. I didn't get to go over 2017 myself. I think repetitions, though, they look decent. They could be increased, but you got to kind of find that fine line. Now, 2018, this one here goes back into that situation where we're at, you know, almost 700 trades in this scenario, which isn't bad, but those 700 trades, if they're not following proper market concepts, is where you're going to get some issues. Okay, I see. So it's super, super aggressive here. If you want to trade at this level of aggression, you got to understand the edge that's involved. For me personally, I don't even see liquidity sweeps here really, but it depends. It's got to come down to a fine line or some sort of preference that you can establish, because this amount of repetitions in this minute, I can't even imagine testing this much, man. My brain is fried thinking about this set of data. So yeah, stuff like this to me is just not proper liquidity or market structure. Um, I personally, if I'm going to be looking at this, I have a break of structure here occurs right at this high. And when that occurs, this is the overall low that you're working with. So I would have a stop loss at this low, take profit at this high. So I do think, we've mentioned it before where you talked about market structure. I think the biggest thing you got to keep in mind is when structure breaks, you have to be looking at that lowest point of structure to then use that as your stop loss or your overall low. And then on top of that, I think, as we go in more trades, we might find more situations where market structure is kind of faltering like that. We'll take a look. This one looks great to me. So this is a great example of a trade. I see a great sweep here, break a structure, fair value gap, everything follows fine. When it comes to those very small and tiny ranges with aggressive entries, it's different. Mom, I'm just letting you know I'm on call. I'll be done in like 20 minutes. Sorry about that. I got a phone call here. But yeah, I'll keep going through some of these trades. We'll take a look at them. I can't imagine 700 trades in a year though is super, super significant. Now, I think another thing I talked about it when I went over it was like range-based trading. Um, this to me is not really a trading range. It's such a small break of structure to the point where you're not only 50%, but almost even your fib here for entry is beyond the break of structure. To me, it's not a proper trading range. And the point of volume and liquidity in the trading plan is to show significance in the market. These lows and highs are very insignificant overall. You're looking at a 3 candlestick range here. And volume is important to show significance because at the end of the day, we're trying to trade institutionally or following institutional volume. And without that being there, it's just going to lower that win rate significantly. We're kind of seeing a similar situation here where it's just a few candles, not really a significant trading range. Compared to when I'm looking at this image, I would be taking a buy position or have a buy position here where we have a break of structure up, sweep on liquidity. We have a fair value gap in this range as well. So definitely focusing on more significance would be important. My August was pretty break even. I think I was -1 overall in August. I didn't really trade the first week or a couple days in the last week because of trips and whatnot again. But yeah, about -1 for me in August. And then let's see here, keep going a little bit. So yeah, stuff like this, this isn't a bad trade. I do think it's getting lost a little bit in market structure. So my recommendation for you would definitely be trying to be more strict with market structure and how you form it, what you're considering trading ranges. These breaks of structure are just very insignificant overall to price action. When you mark your break of structure, I think you should be doing it on every single trade. I talk about it where people should be marking sweep, fair value gap, and break in every trade. If I mark a break of structure here, my fib is just too far extended beyond. It's such a small range, it's insignificant to price. So that's kind of why I do think a lot of these are lowering the win rate significantly. We're kind of seeing it here as well. This one isn't as bad, but when I look at this, I would also once again be taking the overall low that creates a significant break of structure. This would be my overall low. It sweeps liquidity here compared to, using this little range here is not really significant enough to price action to consider that my trading range. Keep going. I think that's going to be a big one here, though, is just seeing that a lot of these ranges are very insignificant to overall price with very little volume behind them. So this one, for example, the break of structure is definitely not strong enough for me here. And once again, it's just very insignificant. The trades that I would recommend going over trade images, which is in the section, if you go to course content, swing strategy, there's some trade images in there. But on top of that, I would recommend before doing another testing session, reviewing this set of data here, or even, going through some of Sven's webinars, but reviewing this set of data, looking at those trades and comparing it to your own. Notice the number of trades he's getting, notice the ranges that he's using, because that is a huge thing I'm kind of seeing here. Regarding the trades I've just looked at, a lot of them are very small and insignificant ranges. So I really would recommend looking over Andre's set of data here. We have like triple equal lows here, for example, with a very weak break of structure above this high. Stuff like that, getting used to marking out every piece of the trade more, and also looking over other people's sets of data before going into your own and trading this very aggressive style, but not really having enough visual representation of a profitable trading set of data. Yeah, you could do that too if you want to like ask Sven directly certain things about his testing versus yours, or even like compare certain years of data that he has versus ones. That's why I recommend Andre's set of data. Is you haven't really entered the 2020 to 2024 range, but maybe go through and test 2020 and look at the difference in repetitions. My opinion is that you have such high repetitions here, 700, because the quality of the trades are just so significantly low due to those very low volume ranges or low quality ranges without sweeps that we're looking at. Stuff like this, for example. This just isn't really anything significant enough for me to take a position. If anything, I would be wanting to take a short position here because I see a great sweep on liquidity, break a structure to the downside, fib at the high, TP at the low. Something along these lines would be more up my alley. It's okay to be aggressive like this, but you got to keep in mind we're still seeing a lot of weak breaks of structure here, and some very insignificant ranges to price. After August, how much am I up for this year? I think like 35 RR right now. And without the break-even rule, I'd be only at 25 RR. See, so even this, I would still have my, you definitely got to focus on when you mark your break of structure, your take or your stop loss should always be at the overall high that breaks that structural low. That's why I think it's important to mark your break of structure each time. And similar to this. So this is kind of what I'm talking about when I say trading ranges. There is no trading range here. And this is why it's super important to picking which market structure. This to me is not market structure in general. And it's one of those things where I would consider this a forced trade, a trade that's being forced somewhere where there isn't a setup present. If there's no setup present, it's perfectly okay to let that pair do its thing and keep going, as opposed to trying to involve yourself in every little high or low to the market that's very insignificant. If you draw your break of structure here, it's literally like one candle. And this to me is not a significant trading range or significant enough to price action to have a form of reaction to it. Would this be too aggressive? No. I think if you're talking about this break of structure and this low, I think that's perfectly fine. It looks like a great trade to me. It's got a fair value gap, a sweep, and a break. Look at the difference between this low and this high in the range that we're trading here versus, let me grab an eraser here real quick. So that range from that low to that high versus this is your trading range in this scenario. And you don't really have a break of structure here. You don't have, any type of movement. It's actually a singular candle that you're using for a trade here, which in my opinion is just going to lower that win rate significantly. Close some of these out here. I do think, in my opinion, that's going to be the biggest issue here, and it's why it's such an aggressive set of data. And, I'm seeing it on all the losses. So once again, here we have just a couple candles that are in price action. Choosing which one. Let me see. I think you would need to draw. So your break of structure here that you drew, it's the overall. Let me see if I can pull up that image again. In my opinion, there is none, and that's probably why there's confusion. I would not draw this break of structure and then set a trade here. just because there's a break of structure, we still need other aspects of the plan, or at least some type of consistency regarding how we're going to enter the market. I personally would see this pair right here. Oops, my drawing was a little off there, but I would personally see this pair doing what it's doing right now, and I would not have any trade on it or anything. And it's perfectly fine to sit out of the markets, in my opinion, in your case. I think you need to get more comfortable with sitting out of the markets when there isn't a possible trade or a good quality trade, if you want to call it that in general. Because in my opinion, these types of trades end up being forced. And when that happens, you're going to significantly lower the win rate while taking a lot more losses. I would say the same thing about this trading pair. There needs to be a clear and present range for me to take a trade. And this to me is just not a trading range. It's just a few candlesticks that may have been bullish before a bearish move. And trying to force trades in market situations like this is going to drastically lower that win rate. This is a great trade. Nothing wrong with that one. But yeah, once again, there isn't really a good break of structure here. I think it's fine if you want to keep it consistent with that candle close, but we came right down and right back into the range. I think this is a fine trade as well. Looks a lot better here. Also, not a bad trade. It's still definitely a bit aggressive here. But yeah, I like the volume within that candle. So this one I would consider pretty, in my opinion, a bad trade. I think a big thing is it seems like some trades are being forced when the markets don't have a setup present. I would really recommend trying to ease off the gas a little bit. Don't try to take a trade at all times on all markets. This break of structure is so insignificant to overall price action. I think taking a step back, maybe watching our volume and liquidity course content again, because volume and liquidity at the end of the day is what drives the markets. It's understanding that institutional order flow, understanding that institutional movement is what we're looking for. Liquidity and volume show that. And without liquidity or high volume, you're really kind of just in no man's land with some of these. And it's going to lead you to have a significant drop in that win rate. You mentioned scrolling down a bit. Some trades here. This one looks great. Also looks better. So this one here, I also think, once again, it's kind of a forced position where there isn't a clear trading range here. We have like no fair value gap within this general range area. And even then, if you draw your break of structure on here, it's just overextended. I think the biggest thing is you gotta focus on ranges more. A trading range is a break of structure to the upside from some price action like this, and then we have a fib entry and a TP at the high. Compared to what I'm seeing here in a lot of these trade images is more something along the lines of this. Price is running super heavily, has a little retracement, and then you're trying to essentially force a trade in a range like this with almost like an order block or a few candlesticks, as opposed to just focusing on a full trading range. You're saying I should take the full bigger range. I think this scenario, either one, it depends on your comfort level here. I think both would work. The difference that I'm trying to point out is the ones where it's those very small few candlesticks that are within an area. This to me is not really a significant trading range. Even this, something like this, it's just a slight pullback in a massive trend and barely a little break of structure here. I think it's forcing a lot of positions. There's a lot more trades on this set of data. It's like 700 sets or 700 trades in this set of data, but I do think a lot of them are being forced when the markets aren't presenting a good solid setup. I think my biggest takeaway for you, I'll probably wrap up the webinar pretty soon, would be review Andre's set of backtesting data, for example, compare those trades and really try to cut down those single candle trades that we looked at earlier, like this one, for example. Really trying to cut down on these kinds of trades, because this to me is not a trading range. It's just kind of like an order block, if you want to think of it as that, or just a few candles. Realistically, there's so much noise in the market that if we signify 4 good candles as a range or a good setup, there's going to be unlimited setups that have a lack in quality. And I feel like it's kind of what we're seeing with that, you know, addition of about 700 trades or so in a year. It's a lot. One candle, I don't take these. If you're referring to these, I don't typically take them. If you're referring to one candle, like a big candle that breaks structure and it's just a single candle, I don't take those that often because I don't have good results with them. But if you're referring to like a one candle range like this, I don't like these trades. In my opinion, don't follow the plan. I know pound USD. If you're referring to something like this, I don't typically take these. Yep, yeah, I don't typically take these often. I think it's perfectly fine though if that's something that you're used to taking or see. I haven't seen it a lot in testing, so I don't take it. That's kind of my big thing. If I don't see it a lot in back testing or not used to it, then yeah, I think that's gonna be my biggest takeaway. I would really recommend going over some of Sven's sessions and Andre's backtesting data, and then comparing that to your own. Maybe even testing a similar year to them, and then going from there. Because I think the biggest thing it's lacking is significance in price, understanding what significant volume or significant structure, and just understanding volume and liquidity overall. I would recommend rewatching the course videos as well, the liquidity and volume one specifically. Could you maybe also do an FX replay session? I probably could. I barely use the new version of FX replay, which is why I don't typically. But yeah, I think it's the significance that's got to be focused on a little bit more because those ranges, 700 trades in a year is so much. But if there's a lack in the understanding of volume and liquidity, it's going to really hurt that win rate overall. Other than that, do we have any questions before I wrap it up here, maybe? No other questions. I see some people typing. I'll wait it out. Yeah, and like you said, if you want to like go, ask Sven or something after a certain session or backtesting result on 15-minute, not that I know of. I don't think anybody here uses it on the 15-minute. In my opinion, the repetitions would be so crazy to kind of manage that there would have to be some other rules that are added to the plan or strategy to make it work on 15-minute. It would work, but you're talking probably 100 trades a week with how many pairs we trade. You could significantly lower the pairs traded, maybe, but that could also throw off that edge as well. I think that's a big one too, which Suga mentioned. Going too fast with backtesting definitely will lead to that. Going too quick and just trying to, going through the motions, so much data in such a short amount of time. I would recommend a big break from testing as a whole and solely focus on reviewing the course content, reviewing Andre's sets of data, and maybe even watching a few of Sven's backtesting webinars and give it like maybe 2 weeks before doing another session. It's not worth pumping them out so quick when there isn't a good foundation being learned or established yet. Just waiting for some of the questions to roll in here. I'm trading live market from past 1 week, but I think I should spend some time in back. Yeah, I would recommend back testing. 1 week in the live markets, it's just not enough to draw any conclusion. And one of the biggest issues, I have a whole YouTube video on it, is what I call the euphoria stage, where people might do good for 1 week, they catch a good couple trades, but then they might have 3 to 4 weeks after that where they're negative because, reality kind of sets in and the way the edge works. And it throws people even harder into burnout because they just don't quite expect the odds that are at play here. And yeah, I think I would ask yourself why the 15-minute is what you want to approach. I'll be honest, with the 4 hour strategy alone, there's so many more repetitions than day traders. A lot of people have this connotation because they watch a lot of YouTube or a lot of different strategies at the 15-minute or the 1 minute, 3 minute, 5 minute, they're all optimal. But you got to understand how many more repetitions we get as 4 hour traders than the average day trader. I used to day trade 1 minute time frame and 15-minute time frame in about four trading pairs. AUGU, EU, and UJ were like my four trading pairs. I get more repetitions on the 4 hour time frame than I did when I was a day trader, and in fact even more RR as well because of that increased amount of repetitions. So a lot of people have this comfort on those lower time frames, but you got to understand there's so many more variables that hurt your account. There's more spread, there's more slippage, there's higher impact news events that can hurt your edge due to volatility. There's increased margin and leverage that you're going to have to deal with. You won't be able to place a significant amount of trades on the 15-minute time frame due to more margin being used due to leverage on the lower time frame with a tighter stop loss. On top of that, you got to understand the increased amount of variables from just price action alone. There can be shitty volume days, there can be huge volume days. All of that comes into play on 15-minute time frame. You would have to drastically lower the amount of pairs you trade. It's the only way I could think it would possibly work. And you got to also ask, what leads you to wanting to trade the 15-minute time frame with a strategy that's already proven to work significantly well in the 4 hour. And a lot of those reasons tend to kind of not have too much sustenance to them. It's just what I find from experience. A lot of people get comfortable with certain time frames, but the 4 hour time frame is giving you a significant amount of more repetitions with less time on the charts. I would highly recommend focusing in that on that. Should have grabbed my water. Always, my throat's always killing me after these long sessions. 13. Gotcha. Yeah, so I mean, is there a specific problem that's arise from holding trades too long? I mean, I can understand a lack in patience possibly, but the other end of the spectrum is that on a 15-minute time frame, you're gonna have to place a lot more trades or lower your pairs. The repetitions will be so far increased, and there's a lot more variables that I think would hurt your edge overall. At the end of the day, if you're on the 4 hour, it should get to a point of set and forget. Like you should be able to set your out or your orders and walk away for the rest of the day, and come back tomorrow. That's kind of how it should be approached. So that patience, I think, is what needs to be improved. I think improving patience and understanding that holding trades for a long period of time is in fact better for your day-to-day life because you'll be a lot more passive. Is probably a better option than trying to shift the strategy as a whole to something that is going to take a lot of tweaking and editing to make it work. Bigger, more significant ranges, correct. Overall market structure. I think those two are big, but my biggest takeaway for you was take a 2 week break from backtesting at least. I think you're doing so many repetitions and trying to rush it out, or like you said, speed running it. Take a 2 week break. Focus on Sven has so many backtesting videos on the channel. It's insane. You go into live sessions here, literally, there's got to be, I don't even know, 40 different backtesting videos in here at least that are an hour long, if not more. And kind of focusing on those, and then also looking at Andre's set of data, maybe reviewing some of those trades. Okay, so this is, in my opinion, the overall issue. If you only have 3 pairs, but you're trading a 4 hour strategy, that's why you're losing that patience. We trade about 28 different pairs with the strategy that we use. So, having 28 pairs, obviously you're going to get way more trades. You're going to hold trades for, shorter and longer periods of time in the 4 hour. But, only having 3, it would be like watching paint dry to try and wait for them to have setups available in the 4 hour. That's why we trade such an accumulation of so many pairs. On the 15-minute, I think that's valid. But you're definitely going to have to collect data, like you said, because I'm not quite sure the edge would work in this type of format with only 3 pairs in the 15-minute time frame. Also, no more live trading then? No, I think you can live trade. I think live trading is more of just, disassociate from the data. If you're struggling in backtesting, then live trading is just to simply get you used to placing orders, used to a schedule or routine daily, used to that patience of holding the 4 hour time frame. I think it's fine to do, but disassociate from the data. Don't go into the live trading expecting to kill it on that account. And then focusing on what I said to do outside of that, obviously, otherwise. All right, might wrap it up then. We'll call it a day here. We went a little bit over, but I should have this posted within 5 or 10 minutes or so. Hopefully, the volume's a little bit better for you guys as well. I tried to pump it up on my OBS, so hopefully, it's a little bit louder. And then, obviously, if you guys get any questions beyond, you can shoot me a DM or whatever. But I'll see you guys. I almost said have a good weekend because I'm so used to holding these on Friday, but have a good week. And then, yeah, enjoy the rest of your week. See you guys.